How's it going, fellas? Good evening. Welcome in. Good evening. We'll get going here in just a few minutes. Just going to give a few more people a chance to hop in before we get started. Hey, good evening here too. Nice to see you. Scotty and Avenger here. Good to see you, gentlemen. How's everybody doing this week? Good for me so far, Avenger. It's just getting one of our first big storms of 2026 down here in California. So it's been kind of nice actually. Nice change of pace. I like the rainy weather when it's not my daily. Oh yeah, I forgot you're in LA, yeah. So you're enjoying it too. Flooded for you. Oh yeah, it didn't at least I didn't see anything about any flood around me, but yeah, it's been nice. Solid couple days so far. Good start to the week. Yeah, the flooding's not something to look forward to, that's for sure. Cool. All right, well, we're a couple minutes after the hour. Let's get into it. We got a thinner crowd tonight, so what I'm going to do is tailor the lecture specifically to you guys in here and make sure I don't cover anything that you guys don't want to hear about, just because it is a group of a size where we can do that pretty easily. Um, First question that I have before we get started, tonight's supposed to be about indicators. Usually in this indicators lecture, we talk a little bit about setting indicator studies up, and then we roll into the kind of specific discussion on indicators. Do you guys have any questions on setting indicators up or questions on setting up study sets? If not, maybe I could talk about a couple kind of common study sets that I use, and then we can go from there and talk about just kind of indicators individually. What are your guys' thoughts? Cool. All right. Any other thoughts? We can just roll through maybe a couple kind of indicator study sets that I would recommend everybody kind of has set up or just ready for a quick reference, and then go into a little bit more in detail about every single one of them. All right, do what I had planned. All right, cool. One of the few things you know well is setting up studies. Okay, fair. All right, cool. Well, I'll just do a little brief intro then. I'll talk about a couple study sets that I commonly use, and then we'll take a step back and talk about some of these indicators in detail. So let's swap over to the PowerPoint just very quickly. And let me present this guy. Cool. All right, so lecture six here, the beginner's course series. Again, we're off our normal cadence here. We're doing this on a Tuesday. I think we realized this last class because we had the President's Day holiday on Monday. But after this week, hopefully we'll be back to our normal program where we're just doing Mondays at 6 p.m. and we won't keep switching it up on you all. But I assume most of you are kind of familiar with what we have going on here. We're about halfway through, and we got really 2 to 3 more lectures of just the most kind of basic stuff before we get into the latter kind of third or yeah, I guess you could call it that, of the classes where we start putting all the concepts together. So it should start to get a little bit more integrated as we continue throughout the next few classes. And like I mentioned earlier, typically the first section is just talking a little bit about setting up indicators. We might be a bit more abbreviated in this first section, and I'll talk a little bit more about study sets and that sort of thing. The one thing that I am going to mention is that in general, indicators are not meant to be kind of a golden ticket, just like anything, right? We mentioned the same point for candlesticks. I don't think I talked about it for anything else yet, but a lot of people might think, one indicator or one algorithm is really going to change the game for you. And unfortunately, that's just not the case whatsoever. Just like anything in the market, there's nothing that's ever going to be 100% successful. And indicators that couldn't be any more true. If you can find me an indicator that is successful and accurate 100% of the time, I would love to hear about it, but I think you'll be looking for a little while because I don't even think the most advanced quantitative funds have access to something like that. So just be cautious when you're adding indicators and using indicators. Just like anything in the market, it should be secondary to price and volume, right? Price and volume is truly the most important set of indicators, if you even want to call them that. And everything else that we talk about, especially in this lecture, is going to be almost like a secondary confirmation. So just be cautious on using this as kind of your main reason you want to get into a trade, alone at least. So let's just talk about a couple kind of common indicator setups. I am using Thinkorswim. If you are not using Thinkorswim, this isn't going to be super directly related to your specific platform. Every single platform looks a bit different and it's got some different buttons and that sort of thing. But in general, the way I personally use indicators in my own setup is I save everything in these study sets. And these are kind of just the most common groups of indicators that I typically use, and even some of these I don't super commonly use. The first one is going to be this 20, 50, and 200-day moving average. These are going to be your most important and critical moving averages, and I like to just have these in a study set, so it's super easy for me to just bring them up. Then I have a couple other pairs of exponential moving averages, so the 5 and 13 EMAs, and then the 9 and 21 EMAs, just kind of two pairs used to help determine the short-term trend. Um, I will come back to, oh, actually, that's a good question for now. Yeah, so we just talked about three different moving average studies. For me, the SMAs are going to be when I'm more focused on kind of longer term price action. And these SMAs are going to be ones that you want to pay attention to as kind of long-term levels of support and resistance. So for example, on the S&P or even on the Qs, I think is a bit better for an example. On the weekly, no, S&P is fine. You can kind of see how this 20 weekly moving average here in yellow generally acts as some kind of shorter term support level. And usually once we break below that 20, pretty quick trip down to the 50. And usually once we break that 50, pretty quick trip down to the 200 as well. So just good levels of support and resistance is what these 20, 50, and 200-day moving or 200 moving averages are. And this is just a weekly time frame. You can kind of see how powerful these are. I mean, it's pretty clear, this 50 week is incredibly important. This 50 week is going to be the same thing as our 200-day moving average because a week has 5 days. Oh, never mind. I was thinking of the 40 week. I'm wrong. Regardless, right, this is going to be a longer term daily moving average. And then this 200-week moving average is years and years and years of average price action, like 4 years, last 4 years average. So that's when I use those SMAs, longer term price action studies. These EMAs are typically going to be used for me when I'm analyzing the shorter term trend. These 5 and 13 EMAs, they're real short period exponential moving averages, and we'll talk about what that means. But in general, they're very reactive to movements in price. And paying attention to these can be pretty powerful for shorter term trend changes, but they don't work so well when we're in a range. So that's something to kind of watch out for. Next couple ones I have this set up just for the Bollinger Bands. These aren't ones that I use super frequently these days. A couple indicators that come up below just for monitoring breadth on a market-wide basis. This one isn't going to be one that's a big one on the daily. This one is just, if you guys are familiar with Steve Kalajian, that just matches his setup. I never really use that. This has got my short-term EMAs and longer-term SMAs, the ones that I typically use. This is a volume profile study. That's not anything too crazy. Another EMA setup. This is going to be another EMA setup as well. Let's see. I don't even know what this is, to be honest. I don't remember what that even does. I haven't used that in so long. This is a set of studies that Tilio commonly used in the past. Not sure if it's too common for him these days. I think these two studies are meant to be intraday stuff, and then this is kind of my volume profile study. So I don't really have a super long laundry list of different pre-made study sets. And in general, I don't even use more than 3/4 of these on a regular basis. I usually try to keep things pretty simple. And I know I kind of blew through a lot of those pre-made study sets, but without it telling you what each of those types of indicators mean. So the next thing that we'll do is take a quick step back and start defining some of those things. But just real quickly, if you're looking to set up a new study set, in Thinkorswim at least, you can go up here and click studies. You can also right click anywhere on the chart, go to studies, edit studies. And you can add, whatever you want. We could do a moving average. Let's get that thing. Sure, adaptive EMA, whatever that is, and then moving, uh, simple moving average. There we go. So let's say we have these two averages that we want to have in there. We could come in here and change the color. We could make it look however we want, do something crazy. And then once we're happy with how our studies look, we can go in here and go to save study set, and we'll give it a name. And then forever forward from that point, we'll have this kind of predefined set of indicators that we can just come back to really quickly. So that's just kind of the basics of setting up study sets and some of the things that I use them for. But swapping gears back to the PowerPoint, let's talk a little bit more about the different types of indicators. And here too, did you have a question? Cool. Okay, no problem. All right. So I split the types of indicators up into kind of two main groups for the purposes of this lecture. We have what are called oscillators in this first section. And then the second section are going to be what I call moving indicators. And these aren't really super technical terms or anything super important, but really the oscillators are meant to represent indicators that kind of go on the lower portion of your chart. So it's going to go in a subgraph. So for example, if you pull up like one of the more basic oscillators or common ones like the MACD, you'll notice this is going to pop up into a subgraph below our chart. And if we get what like a moving indicator, for example, like let's just use the VWAP, just something simple, that's going to show up with price, so with the price chart. So that's kind of the different sort of categories that we have things split up into. Oh, and you have a question. Yeah, you can feel free to put your question in the chat or you can unmute if you want.
Yo, can you hear me?
Yeah, I can hear you just fine.
Okay, cool. Well, I know you probably will still get into it, but volume profile, what do you think of volume profile? Because I hear a lot of people talking about it, and I've added it to mine, but I just took off
Mhm.
that little heat map.
Yeah. I actually wasn't planning on covering volume profile today, so I'm glad you asked. In general, I personally think the volume profile is super powerful and I love it, and I have for the last probably 4 years now. This is how I keep mine set up, and let me just change the colors so you can see it a bit better, because it's probably really hard to see on your guys' screens. So yeah, the way that I set it up is I like to make the, I guess, histogram bars or whatever you want to call them a bit more precise. So you can kind of more cleanly see which prices they actually are defined at rather than the default. If you look at this compared to the default, it looks like this. It's a little more blocky and less precise, which sometimes works. But I personally prefer a little bit more detail if I can have access to it. Um, yeah, I think overall the volume profile is super powerful. Yeah, I think it's a great way of confirming strong areas of support and resistance. Especially right now, you can see, these last few days we're basically trading right around that area of strong support. If we break below this 680 area, probably a bit of a red flag. But as long as we continue to hold it, we might be all right and for maybe another bottom here right at this area. So anyway, yeah, I think it's a great way to confirm the strength of support and resistance levels.
Oh yeah, thank you, bro. Thank you so much. I appreciate that.
Yeah, you got it. And I know there's some other things with volume profile that you can do. Like, by default, it'll show you the value area. Typically, I don't use the value area, but that can also be pretty powerful as well. There's some statistics around if price breaks above or below the value area. That's, yeah, generally speaking, going to be a rare event and that sort of thing. But I haven't studied up on that in a little bit, so I'm not super fresh on what those metrics are. Cool. Okay.
Oh yeah, thank you, man.
Yeah, great question. Thanks for asking it. Cool. All right, so let's talk a little bit about oscillators. The first one that I want to cover is the MACD. And this is going to be kind of our simplest oscillator and probably the most typical one as well. This is going to be the one where, most of these internet traders or social media people are going to say, oh, you got to have this on. It's the best, blah, 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 blah. Just to be clear, and just to reiterate my point from earlier, truly, if you guys take nothing from this lecture except this statement, I'll be happy. Any one indicator is not going to be the key to your success. I guarantee it. If you're not trading successfully without indicators, I don't think a single indicator is going to be what changes the game for you, truthfully. So just take that as a note. But let's talk a little bit about the MACD. The MACD stands for Moving Average Convergence Divergence. And basically, the name of the indicator is exactly what it's showing you. It's pretty basic and it helps you determine momentum. So there's kind of two ways that this could be plotted here on the chart. I'm getting a little feedback from somebody's mic, so I'm going to mute the two people with the unmuted mic just in case. Sorry about that, guys. Um, if you had a question, though, feel free to unmute again. But yeah, MACD can be presented in kind of two different ways. This middle subgraph here has this kind of histogram, and this lower subgraph is a bit simpler. In general, what it's doing is it's plotting out two short-term moving averages. And just as a quick definition, moving averages are basically, you could just think of them like a simple average. Like if you add the last four data points and then divide it by four, that would be the average for the day. That's basically what it's doing, right? It's plotting two different moving averages. This one in blue is going to be a shorter term moving average, so it represents price over a shorter duration. And then we have a yellow or brown line, which is going to be a longer moving average, still pretty quick, but it represents price over a bit of a longer period of time. And you can see when that blue line crosses above that brown, we get those green histogram bars. And when that blue line crosses below that brown, we get those red histogram bars. And in general, what this is really trying to show is kind of the direction that momentum is in, and if it's increasing or decreasing. And we know momentum's increasing when these two moving averages are gaining distance from each other. So if the gap between them is widening, you can think of that like momentum is increasing or diverging if we refer to the name of the MACD. And then when we see this histogram kind of decrease in size, that would be momentum kind of converging as those two moving averages are coming together. And the one thing to note with any kind of moving average or MACD in this case is that they're going to be super, super useful in trends, but very useless in ranges. And that's why kind of an understanding of price action is so important, right? If you look at the S&P right now, I pulled up the 9 and 21 EMAs, which, is a pretty popular set of EMAs. And in general, right, when we're in a trend, you really want to see these two moving averages hold as support. And now that we've kind of developed a range, we've lost these moving averages multiple times and really nothing's happened. There's been no real downside follow through. And these moving averages really aren't respected too well as support when we're in a range. So that's kind of an important point, right? Moving averages and the purpose of them and the usefulness of them kind of goes out the window once the market gets into a ranging period. And that's where your kind of price action analysis sort of skills really need to take over and kind of ignore what you're seeing in the indicators because you might have wanted to long 3 days ago when we came back down to these moving averages and it might have been support and we blasted right through it just like we did a few days before and the few days before that. You might have wanted a short a couple days ago when we came back to those moving averages. So anyway, they just really don't follow the rules that you would expect when the market's in a range, which is generally why I like to try and avoid trading range environments. This is a bit of an aside. We're certainly in a market where there's some good opportunities. It's more of a stock pickers market than the last, year, I would say. But with that being said, it can make things pretty difficult. All right, so kind of back on track here. The MACD, again, pretty straightforward, right? When we're seeing positive momentum, that histogram is going to be green. When we see negative momentum or bearish momentum, that histogram is going to go red. And just to be clear, when I say histogram, I'm referring to these red and green bars. That's typically what you would call a histogram there. So a couple things that you can do with the MACD. The first is looking for crosses to the upside and downside for a signal. So for example, here we get this cross to the upside, right? We see this blue line coming above the brown, and we also see this histogram flip from red to green. And you'll see that this was the beginning of a pretty nice uptrend higher. And then here you can see we get this bearish cross, right? So the blue line drop below the brown, and you can see decent downtrend following that as well. And like I mentioned earlier, that convergence or divergence indicates the strength of the trend. So as those moving averages are gaining space between each other, it's got positive momentum. It's a very strong trend. And as those moving averages are coming closer to each other, generally speaking, you're going to expect a weakening trend in that case, right? So you can kind of see if you just focus on this specific window between these two arrows of price action, You can almost see it if you look at the candles too, right? This first part of the section, we have bull bars closing near their highs. We're leaving behind a bunch of gaps as well in that initial move higher. Then you can see we kind of slow down a little bit right in this area, right? We start to get a little bit of selling, a little bit of upper wicks, and then we almost speed up a little bit more, right? We get a few more bull bars closing near their high. And from here, right, it's very clear that momentum faded out, right? We spent basically, I don't know, 15 to 20 bars trending here. And then we spend 10 bars basically in a range. And during that period, right, we had our MACD kind of whittle all the way down to zero, where there's no momentum in either direction. And then that turned into some bearish momentum right around the time we got that breakdown. So all that to say, in my opinion, and I don't mean this to be a lecture bashing on indicators, truthfully, and I think it's important for everybody to understand that they have their place. But I personally feel like that we can draw the same conclusions that the MACD is going to lead us to just by analyzing price action alone. Um, I look at this chart and I feel like you can pretty clearly see like very strong bullish price action at the beginning. Same thing here, right? See very strong bullish price action here, also very strong bullish price action here. We don't always get this incredible follow through to the upside. In this case, this breakout reversed. In this case, this was a bear market rally or a rally in a downtrend. So can't really expect that one to follow through too significantly. But anyway, that's kind of how to use the MACD there. And that's just a couple examples of that convergence and divergence, right? You can see as we're diverging, that trend is usually pretty strong in the other direction. And once they start to converge, that trend is generally weakening. Same story here, right? Really, really strong downtrend. And then obviously, as those histogram bars start to converge a little bit and decrease in size, that downtrend and pullback really slows down. And we actually got a little bit of an upside rally in that case. So that's kind of the MACD. Again, I'm sure many of you have probably even heard of it before or seen it online. I feel like it's a rather popular one. And in this lecture, we're talking about most of the, what I'll say, popular indicators are, just because I think it'll probably be the most relatable group of indicators. But just to be super clear, we could never have a lecture covering every single indicator in the world. Thinkorswim alone probably has like 300 built-in indicators, and the amount of things that people have built custom, it's, I don't know, hundreds of thousands probably. So we're never going to be able to cover anything in its entirety, at least in this lecture, but hopefully at least this maybe helps motivate you into further research or sparks your interest, that sort of thing. How good is it watching live? You never used it, but wondering if it would help validate entry. Gabby, I like the way you worded that sentence. Just to be clear, what I did like, I like how you said if it would be used to validate your entry, right, on top of two other conditions. I think that's a really important learning lesson, right? We shouldn't ever be using one thing alone to justify our entry. And I love how you mentioned you would want this to be a signal that you look for on top of others. I think that's a great thing to internalize and keep in your mind there. It's going to be just like watching any movie average live. Every indicator innately is going to be a lagging indicator, so it's never going to be perfect, right? And we could even, pull up the MACD on something that's working right now. Yes, we're going to have to look at the 1 minute chart, and it's definitely going to be kind of crazy. But every indicator innately lags, right? Because the indicators have to calculate based off of price. And in the case of the MACD, right, it's using a 12 period and a 26 period moving average, and an exponential moving average at that as well. So it's really going to be kind of out of sync with what's going on right now in the present moment. And we can even try and check up on that too. Let's take a peek at that. I don't know why it's like so weirdly zoomed. So for example, right, in this specific case, the MACD topped out at 1815, which was, we had already put in the top, right? So it crossed to the downside right at 1815, and then the downtrend started, which, that signal, if you did sell, it would have worked for you. You would have made, I mean, this is a 1 minute chart, so you wouldn't have really made much, actually. This is like basically nothing. But that signal technically worked, right? This one here, we can see this one signaled us to buy on the breakout. And again, just try to imagine this isn't a 1 minute chart, but you have a little bit of a breakout here, and then our MACD crosses. So, not a horrible buy, I guess, but obviously the bottom was way back here in this specific section. And we're just looking at the 1 minute, so this example isn't going to be incredible. And now, maybe price is putting in what could be a bottom, and the MACD is still signaling us to sell. So let's check back up on this. Let's just say right now, let's just write what we would do based on the MACD. We would probably sell based on the MACD right now. Um, we are seeing the histogram kind of converge a little bit. So maybe you could make a justification to buy if we retested maybe this prior breakout or something like that. But yeah, we got to be a little careful because we're kind of trading off the 1 minute here, and that's never really a good idea. But anyway, Gabby, it's not bad. It's going to be just like any moving average, right? So you have to understand that watching indicators in real time is super valuable and obviously the normal way of implementing it. Um, but obviously, just like anything, you have to wait for the candles to close. Like for example, we might see a candle like this, and if we go just fake a crazy close, let's do like 6,900, 6,900, right? At some point, the candle could look like this. Oh, didn't even let me do that. Okay, well, I tried. But anyway, you guys probably saw it for a second there, what it could look like, right? But it doesn't matter until the candle closes. So we have to be really careful about making trades on candles that aren't closed. We got to wait for the bar to close before we make our decision on whether we want to buy or sell. And again, here now we're just continuing to watch the 1 minute. We're seeing maybe some continued converging on the MACD, and maybe we're seeing a reversal over these prior highs. So maybe we decide we want to buy if we get a close above these highs, right? Again, we're getting pretty into the nitty gritty, and just to be super clear, this is not how I typically trade, but just kind of spitballing some potential ideas here. Okay. And now we have some, yeah, kind of sustained convergence. So maybe we're going to anticipate a reversal if we get a close up here. Maybe we buy, maybe we could say buy here. I don't know. Cool. Okay, Ant asks, what timeframes do I use before entry? I'm generally speaking only looking at the daily and weekly timeframes. Those are going to be where I get my trade ideas from. So if a chart doesn't look good on the daily or weekly, you're not going to see me involved with it. Usually, what I'll do is I'll fine tune, my stop losses or my entries based on the hourly time frame. So at times I'll look for an hourly close above or below something to enter or exit a position. But the only time I look at the 5 minute is for fun, if I'm just kind of curious to see how something's moving. But outside of that, yeah, I'm not going to pay attention to anything on the lower time frames. How many charts do I look at weekly for plays? When I'm scanning every night, usually it's about 100 a night-ish. Sometimes it goes down to about 60. But I don't have like a quota for what makes my watch list really. Like if nothing looks good to me, then there's nothing on my watch list. Like right now I have nothing really. I think there's plenty of really strong themes and strong stocks like memory and optical names, SanDisk, um, go back to the daily here. SanDisk, Light, CN. Um, yeah, I think there's plenty of really strong stocks. It's just that they're not at the point where I can really enter them. Even like some airlines, LUV, Victoria's Secret was looking decent as well. Um, and maybe this is a little bit closer to somewhere that I could justify an entry off of. But anyway, yeah, I don't have any quota for what makes it on my watch list, and I just look through whatever pops up on the watch list. Yeah, BE looks nice, holding that 135 area. Cool. Yeah, and it can be super good for practice too, As you get quicker, you can look through 50 charts in 15 minutes, right? I mean, usually what I'll do is something like this, where I'll pull up my watch list or my master watch list here, and then I'll just start clicking through. And if it doesn't look good immediately, I'll just keep going. And when I see ones that look good, like this one actually looks okay, that actually could look decent as well. That's gone. No, no, it could look good. No, 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 no. So anyway, you can kind of look pretty quickly and just go through these. You don't need to spend too much time on the ones that aren't gonna be actionable for you. Um, but anyway, that's kind of my workflow. Looks all right. You got me scanning. All right, cool. Okay, next one is gonna be the RSI. This one's a lot different than the MACD. This really isn't even an oscillator. I guess, in the more simple definition, but I'm just looping it in with the one because it's one of these subplots. This one stands for relative strength index. Hopefully, you guys can all see that it's this plot below. And there's kind of two areas to watch out for. So generally, this is an indicator that has a value between 0 and 100. And when the value of that indicator is below 30, usually that represents a condition which we refer to as oversold. When it's above 70, we refer to that as a condition where we call it overbought. When a name is overbought, typically that might represent that it's overextended, like too many people have bought too quickly and it might need to rest or pull back. And oversold is the exact opposite, right? Too many people have sold too quickly. Um, I think that's a more elementary way to look at this indicator. The most fascinating thing to note is that something that's overbought isn't always necessarily a bad thing. If we go back and look at Tesla, and look at Tesla back in like 2020. Let's do that really quick. RSI, get that on there. Give me 1 second to get this chart set up so we can do this. Let's go back and look at Tesla. So you'll notice in this section here, Tesla was, maybe it was a weekly that was like consistently overbought. No, maybe I'm wrong. Let's go back here. Tesla was pretty consistently overbought above 70 during this time frame. And if we just zoom into the price action around here, right? Before COVID, this thing was overbought above 70 for basically a month. Never really was a short. Then before COVID, basically for 3 months, it was overbought. Never was a short. The only time it actually pulled back was, when the entire market pulled back for obvious reasons. It was COVID. And then again, right? Overbought right coming out of COVID. Never was a sell, right? I mean, maybe you could have shorted the tippy top here and maybe you could have covered right here. But there was just so many instances of this name looking horrible on the RSI, yet it was really never a sell. You could have maybe caught the pullback right there. But if you look in the grand scheme of things, this thing was overbought for, basically half of the year, 6 months out of 12, and then doubled after all of that. It went from 150 to 300. So you got to be real careful with, again, making decisions just based off of one indicator, right? And that's, I think, one of the most important concepts for me to convey tonight is just because the RSI is overbought, that doesn't mean it's a sell, right? That actually could be a good thing, right? RSI went overbought right before this breakout, and then it got more overbought and more overbought and more overbought and kept going higher. So it's really just something that you can kind of look at and say, all right, it typically, I think the way that I like to reference this sort of indicator is if I see, a really good stock go oversold, like for example, a company that might be a great example of this is like Amazon, right? Amazon is probably pretty close. Yeah. Amazon is super well oversold. When a name's in an uptrend overall on the longer term and you see it go oversold, probably not a bad time to think about a buy, right? If I'm a long-term investor in Amazon, I'm buying right now all day, right? It's 25% off the highs. I'm buying Amazon here for the long term, right? It also just filled this gap here. I'm not looking for a quick flip, right? I'm not looking to sell it for, 10% gains the next week, but I'm going to start buying shares long term in this name for sure. If I'm just caring about the RSI, right? It's a quality name and it's clearly moved real down real quick. And now the RSI is kind of confirming that. So that's kind of one example of how I might use the RSI. The opposite is also true, right? And I'll just look at inverse Amazon just for the time being, just because I can. If a crappy name that's been in the downtrend is overbought, probably a good time to sell it. And I think Rivian is a good example of that. Rivian, if you look on the weekly, is a pile, right? I mean, it's basically in a downtrend or in a range. It's gone overbought on the weekly one time. That was a sell, right? So I think it works best on names where the trend is kind of the opposite direction of the signal that you're getting. So if you're getting an overbought signal, but the longer term trend is down, probably time to sell. If you're getting an oversold signal and the longer term trend is up, probably time to buy. So that's kind of how I would use the RSI. If you just look at it very simply and just say sell when we're overbought, buy when we're oversold, you're going to probably lose a lot of money. It's certainly not that simple. However, in some cases, it is that simple, right? Rivian, if you sold every single overbought print and bought every single oversold print, you would have made a great amount of money so far. You're 3 for 3 right here. So there is certainly a time and a place. All right, let's see what else we got. Oh, I forgot to mention, the RSI also has divergences that you could look for. I forgot about this, that the PowerPoint covers this. So, for example, sometimes you can see price makes a lower low, right? And we know what that means, but the RSI makes a higher low. That's going to be called a bullish divergence. And that's another thing that you can look for on the RSI. Basically, what this means is that the stock has gained strength while the price action looks weaker. So that could be a nice buy signal. And the opposite is true for a bearish divergence, right? If price makes a higher high and the RSI makes a lower high, that's going to be a bearish divergence. So that would be a bearish signal. Okay, next one that I have covered in here is called the TTM squeeze. This one was super prominent when a lot of you guys were doing the voice chat and flips with flips. This is one that's really not my personal favorite indicator. I don't find it to be super useful. I'm just somebody who always wants to focus on price action first. And when indicators feel like they kind of duplicate the same sort of information that I could get from price action, I'm just not the biggest fan, but I'm obligated to explain it and kind of show you guys how these things work either way. So let's talk about TTM squeeze, right? Basically, there's kind of two things going on. You have this histogram and you have these colored dots. These red dots generally indicate a squeeze, and then the oscillator indicates the direction and strength of the trend, similar to the MACD, right? So you can think of that oscillator or histogram just like the MACD, right? If it's positive and those bars are increasing in size, that's good, that's bullish. If it's negative and those bars are increasing in size, that's going to be, bad and bearish. And unless you're short, then that's good. And the difference here is these green and red dots. So the green dots is when, well, let's start with the red. The red dots represent when the stock is quote unquote squeezing, right? It's kind of just another word for consolidating. And what that represents in the context of this indicator is when a stock is consolidating, that means it's setting up for a move or setting up for a trend. Um, when it's not consolidating, we would expect it to be actively trending, which is represented by those green dots. So what you can kind of see here is we have a couple red dots, and then the dots turn to green, and then we have the blue histogram trending up, and that's kind of when the squeeze, they call it the squeeze fired. And it fired to the upside and kind of indicates that the trend would be up from this point. That's kind of how the TTM squeeze works. This isn't something that I've ever personally used seriously, like in my trading. So I don't have too much feedback on kind of the nuances and different conditions that you could use it in, but that's kind of the introduction. And really, it's just meant to show you kind of the diversity of these indicators too. All right, one more oscillator before we get into the moving indicators. This one's called the stochastic slow. Sometimes they're also just referred to as the stochastics. This is one that Tilio was always pretty big on. And this is one that's kind of a combination of both the RSI and the MACD, at least conceptually. So it has these 80 and 20 thresholds. Above 80 is overbought, below 20 is oversold. And it also has this oscillation component similar to the MACD. And it has this red line and pink line. The red line is going to be the same as kind of that quicker moving average or more reactive line. And the pink line is going to be that slower moving average. And when we have the red line cross above the pink, that would be a bullish signal. Red line below the pink would be a bearish signal. And another kind of coupled bullish signal would be if we're coming out of this oversold condition and then the red line crosses above the pink, that's going to be, a nice bullish signal. And if we're coming out of this overbought condition and red line crosses below the pink, that would be a nicer sell signal, right? We kind of have that confluence there within that same indicator. Yeah, this is one that I used to use years ago, and it's not something that I really incorporate on a daily basis anymore. I feel like in general, most new traders follow a path where they kind of start with no indicators, then add a bunch, then slowly taper them all off again. At least that's the path that I followed. So things are pretty simple for me now, but that's kind of the stochastics. All right. And here's kind of an example of a couple of those signals, right? We have once we're coming out of this oversold condition, we get that cross, nice uptrend up. Coming out of overbought, we get that cross to the downside, nice trend down. Obviously, these two indications are kind of cherry picked, right? We got plenty of not great signals here, like this one that would have made you short, you would have got blown out. This one, you would have longed, probably wouldn't have made much money. Here you would have shorted, you wouldn't have made much money because you would have stopped out here, which you would have been flat. So, if you traded all these signals, you wouldn't really be doing all that well. Maybe it would break even, at least on this specific chart, but not a definitely not 100% successful like some people might want you to believe. All right. Oh, I don't know what happened to that question, but that's okay. We're a little short on time, so I want to keep going. I never remember how to time these lectures appropriately. But anyway, how you guys doing so far? I've been kind of talking at you for the last 40 minutes. I know it's probably been a lot, but yeah, how you guys feeling? Getting a little bit better of an understanding of just some generic types of indicators and how they work and the options available to you all? Cool. King's feeling good. All right. Thanks, Alex. I appreciate that. I'm glad to hear you taking notes. I love that. Cool. All right, sweet. Thanks for letting me know, everybody. Glad to hear you guys are doing all right. And as always, everyone, if you have a question, I really want to hear it. I guarantee you, if you have a question, somebody else has the same one and they're not saying it either. There's no shame with asking a question that maybe sounds stupid in your head or whatever. Especially because a lot of you, your real name's not even associated with the account. So El Jefe, I don't know who that is. You could ask whatever you want. And I'm never gonna know. You change your name next time, and I'm not even gonna know it was El Jefe. Anyway, all right. Let's keep rolling. Let's talk about moving indicators. These are going to be, at least me personally, these are kind of my favorite and bread and butter at this point in my trading career. That doesn't mean they're the best or the way to go, but it's just kind of the way that I've optimized my trading style. We got one question about from Gabby. Let's see. Usually don't like indicators. Totally trying one. You have a question about what I look for when reviewing stocks, order block or momentum to revert. Yeah, that's a good question. Yeah, so in general, Gabby, what I look for personally is first and foremost, I'm looking for strong stocks. I'm looking for relative strength, and I'm looking for strong themes as well. So I'm looking for kind of sectors or themes that stand out among the rest of the market. So you heard me name two already, memory and optical names. Memory, like SNDK, SanDisk, Micron, Western Digital, Seagate. Those are going to be, all part of that memory theme, if you will. And all these stocks make memory. They make RAM for computers and servers. And if you don't know, why these stocks are so prominent, in general, AIs need a lot of compute. And right now, there's some really, really significant bottlenecks within the memory industry. And additionally, right, another way to know how strong these stocks are is some of these names are like doubling or tripling or quadrupling their earnings quarter over quarter. Like if you look at SanDisk, right? Literally, well, this one recently split off from Western Digital, but literally, not more than a year ago, this thing was making 30 cents per share. Last quarter, it made, or 2 quarters ago, it did a $1.22 per share in earnings. That's a 4x. And then the quarter after that, it did $6.02, 20 cents earnings per share, another 4x. It's just disgusting how much money these companies are raking in, and it's crazy the forecast that they're able to maintain as well. So, again, that's neither here nor there, and that's just kind of part of the story for some of these strong stocks. But in general, right, what I'm looking for is strong price action. I'm looking for names that maybe trend higher when the rest of the market is flat, or I'm looking for names that close green when the market's red, or trade near highs when the market trades near lows. And some of these names are really strong examples of that, right? SanDisk, optical names like Light, CN, they make fiber optic products, which basically is used for like networking and interconnecting different servers and switches and IP networks and that sort of thing. Um, and then there's a couple other, real big themes. I don't have too many copper and silver and gold miners off the top of my head, but I'm sure you all know, right? Yeah, FCX is a great one. Yeah, a lot of these companies are just like VNN is uranium, BORR, they're drilling, God knows for what, probably, yeah, oil and gas. So a lot of materials, like raw materials companies, have also been really strong. So in general, I guess this has been a really long-winded answer to your question, but what I'm looking for is strong stocks within strong sectors. And within those strong stocks and strong sectors, I'm looking for nice, well-defined areas where I can enter. And one of my favorite examples recently is Rocket Lab. It's been a while now since I've been involved in this name, but you can kind of see how I traded this one. And let me just pull up my actual indicators here that I was using. So Rocket Lab was sitting in a range, right? Sitting in a range. It was a strong stock. It was setting higher lows, right? Higher low here, higher low here, higher low here. And every single time it set a higher low, it was coming right up into that 50 simple moving average and holding it, which was a good sign. And also, this name continually had like really horrible news and continued to not break down. Like here, they did a $700 million, or yeah, $750 million share offering. They didn't, the price didn't break down. It had one bad day and that was it. So every single time, sellers stepped in, it never had any follow through, which I actually even noted here on the chart. And then right before I enter, they added 10 new planned missions. The stock didn't react at all. And I actually took the trade 3 times before it worked. I tried getting long, let's see, I think I longed it here and then that didn't work. And I don't even think I trimmed here. I think I sold for break even. Then I longed here and again sold for break even. So all I was really doing is trading breakouts of these mini ranges, right? You got a little range here, and a little range here. So all I was identifying is strong stock, strong sector, support, and finding the breakouts of little ranges near support. That's all I was doing, right? And it worked great. Eventually, the name moved out of this range and did, a nice 50% for me. I sold most of it by here. I think I was out on this day for 35. Let's see, what do my notes say? Oh no, I sold everything. Okay, basically at 65. So didn't sell the top for sure, but got some pretty good sells. And then eventually tried it again here and then got stopped out the same day. That was not good. Um, but anyway, that's kind of what I look for. A name that looks pretty similar to that is LEU, right? Same idea. This is a nuclear stock. Nuclear was super hot towards the end of last year, not so much anymore. But same story, right? Strong stock, strong sector, and had this really nice consolidation right at the moving averages. Broke out here. I got long, held it for a long time actually, and sold this one pretty early. I eventually sold it when I hit uh, I was up like 10x my risk and I was like, all right, I'm just gonna sell it. And I was actually pretty pissed I sold it because then it kept going and I was like, damn, I'm kind of an idiot, but whatever happens. Anyway, yeah, so that's kind of what I look for. Sorry, that was a super long-winded explanation, but I think it kind of helps because we're talking about indicators or moving indicators, and the moving indicators I use are exactly what we're about to teach about. I'm going to come back to your question at the end, Avenger, because I totally just spent a lot of you guys' time talking about that one question. But I hope that helps more than just Gabby. But if not, Gabby, let me know if you have any follow-up questions. Cool. Okay, let's talk about moving indicators. They're pretty simple though, everybody, and they're not too bad. Moving averages, there's a couple different types of moving averages. The ones that are going to be most important to us for the purposes of this class are simple and exponential, but there's like a displaced moving average, there's like a whole moving average, there's a bunch of crap. I only use a simple and exponential, but there's plenty more. And I'm going to actually take that off the screen for now. Simple moving averages are super simple. It's in the name, right? It's a simple average. If I'm averaging the cost of 5 gallons of milk and 1 gallon of milk is $3, 1 gallon of milk is $4, and 1 gallon of milk is $5, I add three, four, and five together. Then I divide it by three because there's three data points, and then I get my average, right? Which is just going to be $4. That's all the moving average is doing, right? All it's doing is taking the close price over however many bars and dividing it by the number of bars you select. So for example, if I have the 20 period moving average, or 50 period moving average, which I have here in white, it's taking the average of the 50 candles before it. So at this point, it's taking the average of the 50 candles before it. And here it's taking 50 candles before here, dividing it by 50 and then plotting it. That's it. That's all the moving average is doing. It's really just the average over the last X amount of trading days. That's it. Super simple. The exponential average is not that simple. In general, it is still averaging, but it gives more weight to recent price action. And that's kind of how that exponential component comes into it. So for example, if I compare, let's just compare really quick. Let's clean everything off. Let's put on a simple moving average. And we're going to do the 20 period simple. It's going to be in blue and it's going to be big size and it's going to be dashed. Then we're going to do the 20 period exponential. Exponential. And we'll do same 20 period, so length 20, and we're going to make it pink. We'll make it big, and we'll leave it like that. So, and let's zoom into kind of over here. So as you guys can generally see, that exponential moving average just follows a little bit closer to recent price action, right? And here it wasn't quite that, it didn't follow price action as closely, but most of the time that exponential moving average is going to be closer to the current price than the simple moving average. And that's just because it's giving more weight in its average calculation to today's price and yesterday's price. Whereas a simple moving average is literally just a simple average. It's adding them all together, dividing them by 20. Moving average is doing a little bit more than just that. And I don't have the formula off the top of my head, but it's not super important. You just need to know that it's going to follow price a little more closely. And there's a couple things that you can do with the moving averages. The first and kind of most important thing is using them as support and resistance, though. And we talked about that at the beginning of this lecture. Let's just zoom out. I love using these longer term moving averages as support and resistance. Um, yeah, usually the first pullback after a big rally into the 20 moving average always gets bought. That didn't exactly happen on this name, which is kind of funny. Let's think about one that did. Oh, NVIS is an excellent example of this, or the fifth, or sorry, 20 weekly. No, I'm getting things mixed up here. What am I saying? I don't know. Anyway, the first pullback into these longer term moving averages after big rallies usually gets bought. So in orange, you have the 50 simple moving average. We didn't touch this level until May, came back to it in October, and literally the first wick of it got bought and rallied like 40%. And that was a really fun trade that I even took, literally based off of that alone. It was a strong stock, nice pullback, previous level of support. I bought it, rode it up to the top, didn't sell it when I should have, and ended up selling somewhere around here, which again, what are you going to do? The same actually is kind of looking a little bit better today too. It's starting to build a little bit above that 93. I kind of like it. Anyway, that's kind of an aside. All right. Yeah, so that's the moving averages. Another couple things that you can do is kind of treat them like the MACD. So for example, I'm sure you guys have seen my EMA ribbon study. I use this instead of the MACD. Basically, what I do is use the 10 and 20 exponential moving averages. And when the 10 is above the 20, that's a positive trend or an uptrend. When the 10 is below the 20, that's a negative trend or a downtrend. So right now on this stock, the trend is technically negative according to the EMAs. In this period, it was positive according to the EMAs. So that's kind of my indication of trend instead of using something like the MACD. The MACD probably is the same, but I just find this to be a bit more effective. And also these levels are very commonly levels of support as well. So it kind of works out. But that's kind of how I use the moving averages. I also mentioned a little bit about the Bollinger Bands. We pulled that study up as well. The Bollinger Bands is basically made up of, let's see if I have the note here. Yeah, so the middle line here in blue is the 20 simple moving average, which we know how that works now. And the red line and pink line are basically two standard deviations above and below that moving average. So really it just represents kind of a high probability area where price will remain within, right? It's generally very likely that price will remain within these Bollinger Bands. And once we start to see deviations outside of those bands, it's pretty common to see prices reverse. And this also kind of has a similar component to like the TTM squeeze, where once you see these bands start to contract, kind of like this, and then expand, you can think of that almost like the squeeze, the TTM squeeze firing, where the consolidation period is kind of ended and the trend is beginning. It's kind of another way to look at those V bands. Um, and yeah, usually I incorporate a little less on standard deviation, but I'm gonna skip that for today just because we're kind of lagging on time here. I think this is the last moving indicator that I have here. And this one's going to be the VWAP, the volume weighted average price. And the reason this one kind of still is important today and also has been around for a while is it actually has had some historical significance. So back before, we could make trades on our phone from the train or something like that, or in these days, text our AI agent to buy or sell something. You had to call your broker to make a purchase. And if five people called a broker to buy the same stock, they're usually not going to execute all those same transactions at different times. They're going to execute that transaction all at once and then dole the shares out to everybody. So what brokers used to be able to do is they used to be able to guarantee a fill at VWAP, where they would say, look, the price might be 430 now, but I'm going to get you a fill for this one at the VWAP, which is the volume weighted average price for the day. So they would wait for price to come back down to that VWAP, and then they would purchase at that time. Or maybe they wait until the next day to purchase it or something like that. So really, it's a moving average at its core. The difference, though, is that the movements are weighted based on volume. And I'll actually show you guys just a quick example of that just from today's price action. And what you're going to notice is when volume is higher, that VWAP line is going to move a little bit more rapidly. So let's just take a quick peek at that. Let me clear out all my other studies. Oh, no, we don't want to do that. Where is that? Studies. And let's put on the VWAP. And I'll make it nice and big for everybody. And let's get the bands off the VWAP because that doesn't mean anything to me. Cool. And let's turn pre-market on as well. See that more clearly. Cool. Okay. So you kind of see it, as volume was higher here at the beginning of the day. Oops. VWAP was a bit more volatile, right? It had this big swing up, then this big swing down. And then as volume kind of tapered off, it was kind of just flat for a while, right? And a little bit of a trend up. And you'll see it kind of follow that same pattern every day, right? At the beginning of the day, it's kind of all over the place. And then for the rest of the day, it's kind of just flat, a little less volatile. Same thing here, right? Pretty volatile at the beginning of the day. That's where it kind of starts that big trend down. And then it really just tapers off, right? When volume's high, we see those more significant moves in the VWAP. And when volume's low, kind of nothing happens. And you can see, right, the price didn't move that far on the end of the day, but volume really picked up and you see a big drop in that VWAP line. And this can be a line that's really common for day traders to be paying attention to. This can be a pretty key level of support and resistance intraday. So that's why it's something that, just makes sense to pay attention to if you're day trading. I know it's something that Dirty River is always keeping up when he's doing his scalping and day trading. It's just a important spot to be aware of, typically intraday. Yeah, look at Avenger. You're going with the VWAP and the hourly 20. Beautiful. That is the River Classic. The hourly 20 is what's it called? Who's that guy? Why can I not think of his name? I don't know. Yeah, there's another indicator. Yeah, the Al Brooks. I like how you knew, and I could not remember his name. There's this indicator that we have. It's like the multi-time frame moving average. So you can take this and you can select the 1 hour, say simple 20 moving average. And then what it's going to do is it's going to plot that 20 moving average on my 5 minute chart, which is pretty cool. So now I have the hourly 20 on my 5 minute chart, which is pretty convenient, right? So I can see that support and resistance just on my 5 minute. So that's actually a pretty nice kind of combination indicator there. And before anybody asks, yes, I've shared it before. And if you want it, it's posted in my tab and I will send you the link. I'm going to send the link in the chat right now. Cool. All right. We'll skip this question because we're out of time actually. And we already talked about examples of study sets. So I'm going to come back to Avenger's question really quick. What was Avenger's question? How do I find these names before the move? Yeah, at least as far as my watch list goes, there's a good amount of times when I don't find names before they move and they don't show up on my watch list until then. That's totally part of the game, right? There's plenty of names where, what's it called? Let's just look at a couple like LITE, right? That didn't start showing up on my watch list until around here, I think, and then I backfilled all this information. But in general, Avenger, usually names that have been strong in the past continue to be strong. So all it takes is names that have showed relative strength over the rest of the market. Like sometimes, I'll build my watch list based off of names that have performed really exceptionally over the last month. So like the top gainers over the last 1 month, the top gainers over the last 3 months, top gainers over the last 6 months. That can be kind of the basis. And just because a name doesn't look good right now doesn't mean I need to stop looking at it. Like there's no possible way anybody could get me to enter light right here. Could it double from here? Yeah, I don't know. Could it get cut in half from here? Yeah, for sure it could. I don't know. But I know that I can't enter it here, right? I don't have a good place to enter and define my risk. SNDK, I probably could enter if it consolidates for a little while longer, but really the entry was like down here and I didn't take it. And that's my own fault. I'm a dummy for that. Sienna, this one I tried to enter here and it's basically doubled from my entry almost at this point. But it's just been really choppy. It just really kind of stopped me out. And it's been hard to stay in. So anyway, a lot of the time I'm not the first person to find a big stock, or I'm not the first person to catch, that initial big move. But usually what I like to do is start paying attention after clearly a name is showing relative strength, right? So usually by the time I'm getting involved, a name has already kind of proven itself as a leader. So I'm not in the business of bottom ticking a stock or top ticking a stock, but usually I'm reacting to names that have already shown and proven that they are able to outperform. Usually they already have, decently positive earnings forecasts and present earnings as well. So anyway, that's kind of how names end up in my lap. All right. Well, that brings us to the end of today's lecture, everyone. Today we talked a little bit about setting up study sets. We reviewed some of the study sets that I have. We talked about two different sorts of groups of indicators, I guess, the oscillators and our moving indicators. And we should also have a homework. Yeah, so I didn't get too many homeworks from last week, so hopefully some of you guys who didn't do the homework last week might want to do this one. So I'm hoping what you'll do for homework this week is review the daily chart of one stock and apply either, the RSI or MACD, or maybe some kind of moving average or VWAP or something like that, and identify one bearish and bullish signal that incorporates both of them, and talk through maybe why it worked. Was the trend in the favor of that direction? Was it recently breaking out? And hopefully this will help you understand that indicators alone aren't going to help you reliably understand what a stock's going to do, right? If you're not taking into account the overall context for a stock, it'll be pretty hard to just look at an indicator and say, yep, this is going to happen or this won't happen. So anyway, take a screenshot of this homework, DM it to me when you guys finish, and I'll be happy to look through it with you and talk about any questions that you might have. But yeah, that brings us to the end of the class today. Thanks as always, everybody, for your time and participation. And if you guys have any questions, you know where to find me. Just reach out, send me a DM, and I'll be happy to talk through anything with you. Thanks, Ant. Thanks, Alex. You guys have a great night, and we'll see you all next time. Hopefully Monday at 9 Eastern next week, everybody. Cool. See you then.